G'day everyone and welcome to the Last Equilibrium's quarterly bulletin for 2025. My name is Robin McLarty and I'm a Business Development Manager at the Equilibrium Investment Management. It is my great joy to be your host today. Thank you for taking the time to join us today and for your continued support for our investment solutions. We have an exciting agenda ahead, but before we delve into the session, let me first address a few housekeeping matters. We have applied for CPD points and expect to receive confirmation from the FBI in the coming weeks. It's important to please watch the full session and add your ID number to the CPD section so that we can verify your attendance. You may also view this event on this platform at any time until the end of December and still receive your CPD points. Our event platform automatically emails you your CPD certificate as soon as you've watched the full session. Lastly, please feel free to ask your questions in the Q&A section and our speakers will either answer them live or get back to you after the event. Okay, let's kick off this quarter session. Setting the scene. First is our Chief Economist, Sanisha Pakrasamy, and economist, Siamo Maseke, who will talk about growth gambits in geopolitical gales. Sanisha and Siamo, we look forward to your valuable insights. Over to you.
Thank you, Robin, and good day, everyone. We are witnessing a landscape marked by shifting power dynamics, diverging inflation, and a cautious sense of optimism. From policy changes in the United States and fiscal challenges in Europe, to China's efforts to combat deflation and South Africa's ongoing reforms. We will explore how these developments are influencing growth, stability, and investor confidence. Sanisha, let us dive into these critical issues and unpack what they mean for the economy and the investor outlook.
Well, thank you, Tsiamo. So I think at the beginning of the year, we all started cottoning on to what kind of policies were going to come out of the US administration regarding protectionism and tariffs. But the big unknown, of course, was how the other countries were going to respond. Were they going to come with retaliatory policies? Were we going to see other trade arrangements being made outside of the US? And I think given that we have seen a number of trade deals forming outside of America, this has contributed more positively to growth in the first half of the year. We saw an element of front loading of imports for US corporates, and this was really to avoid the tariffs that were pending. And that, of course, gave quite a big boost to your inventory levels. And higher inventories also contribute more positively to economic activity. And then quite a positive development relative to the pandemic, and this was around a rerouting of supply chains. Now, if you think back to COVID-19, the pandemic, China was on an extended lockdown. Companies got quite nervous about how they were going to get the raw material inputs from Asia that they needed for their own manufacturing processes. This time around, we've seen that corporates have learned hard lessons and have now started to reroute some of these supply chains. So products came through a lot quicker, and that also contributed to the outcome of GDP for the first half of the year. Ultimately, we also saw that fiscally and with monetary policy, there was also additional support lent to economic activity. So we saw governments around the world spending more from the fiscal side, particularly on your infrastructure, but also military and defense systems. And then we also saw that central banks continued to cut interest rate policy. That, of course, lowers the rate of borrowing for consumers and businesses. And so that adds to economic activity. And then last but not least, I would also put in there the boom that we saw from artificial intelligence or technology. So quite a lot of data centers being built around the world. So that contributes to fixed investment spend. But the nice output from there is higher levels of productivity. So encapsulating all of this, I think there was quite a bit that we didn't really know was going to contribute quite positively to the first half of the year.
Those are indeed a lot of factors that have supported the economy. But has the resilience witnessed in the first half of the year now carried through to the second half of the year, or are we starting to see some risks creeping in?
So I would say that there is some complacency that is setting into financial markets, given that we had this robust economic activity in the first half of the year. And one way that we can see this is through the Bank of America survey for global fund managers, where they ask them, what do they think is going to happen in the next year? Is there going to be a hard landing in the economy? In other words, like a recession? Is there going to be a soft landing? So continued growth, but at a softer pace, more tempered? Or is there going to be no landing? In other words, the global economy just carries along at the same economic momentum. And I think what was quite surprising in the October results is that a third of global fund managers expect no landing.
Okay.
And so given that, the front loading of those imports is now largely in the base, and we also have to take account of the economic delays from the shutdown in the US economy, there will be an impact coming through for economic growth that I don't think is fully being encapsulated by market expectations. There's also an issue around when tariffs actually impact businesses in America. And so for this point in time, they're not really fully experiencing the full tariff rate because of those inventory discrepancies when they import the goods, when the tariffs are actually allocated. And so the full impact of tariffs is yet to actually hit the US economy and spending on that side of things. In addition to that, if you remember the first half of the year, we had a positive surprise when the trade issues actually de-escalated between the US and China. And now going into the fourth quarter of the year, they've picked up again with the US administration promising to increase tariffs even further on Chinese imported goods. And we also know that Donald Trump has also threatened to put an additional tariff on India as a penalty for importing cheap Russian oil. So again, we've got, more turbulence around the tariff policy coming through quite strongly. And then across the Atlantic, we also have some issues in Europe, which could dampen growth the second half of the year. In particular, I'm thinking about the policies that we've seen coming out of the French economy. We now have the fifth prime minister under Macron's second term. Macron is the French president, Emmanuel Macron. They have quite a turbulent situation around the debt dynamics, and there's no clear answer as to how they're going to rein in that fiscal deficit. And remember, what's happening in France is just one item within the entire European region that is showcasing a big rise in populist policies and populist support, which can be quite damaging for socioeconomic implications. And I think altogether, this does paint a picture of slowing momentum in economic activity for the second half of the year.
I think another development that came up was the US government shutdown. So while government shutdowns have not typically affected equity markets historically, they do add a layer of uncertainty and raise political and economic stakes. We also know that it's not uncommon for lawmakers to easily unite on budget measures, and we have seen extensive shutdowns in the past. Can you walk us through what triggered the 2025 shutdown and why does it actually matter for the economy?
Well, at the crux of it, the main issue was essentially the extension of the health and medical tax credits. Now, this matters a lot for those that are buying medical insurance in the marketplace. And if these tax credits are not extended, it does mean that medical inflation will then pick up between 4 and 8% over the next 2 years per annum. And so that can have quite a big implication for consumers' pockets. Now, we know that shutdowns, because they're not really all that uncommon, they don't typically affect equity markets, but they do affect the real economy because policy uncertainty tends to spike, and we also see some dampening impact on consumer sentiment. Now, if we go back to the back end of 2018, we had one of the longest shutdowns, almost 35 days. And during that period, we saw that consumer sentiment dropped to its lowest level in more than 6 years. And so if I look at consumer sentiment as we stand today, it's about 5 percentage points above its all-time low. So consumer sentiment in America quite depressed. And so that means that any other negative news could actually tip over that negative spending, negative sentiment, actually dragging down GDP growth. And what worries me right now is that the Bloomberg median consensus for the fourth quarter growth number in the US is still sitting quite high at 1.2%. And I'm not quite sure if that consensus is fully factoring in some of these downside risk factors that have crept in. And of course, a lot of this downside risk from the shutdown comes through from workers being furloughed. And that means that they don't really get paid while they're not operating in office. And they only get that back pay once they come back. And so there's quite a big chunk of purchasing power that's actually pulled away from economic activity for the fourth quarter number.
On a positive note, though, we have seen efforts by President Donald Trump's administration to broker a peace deal between Russia and Ukraine. And more recently, he was successful in securing a ceasefire deal between Israel and Gaza just before the second anniversary of the conflict. How significant is this development? And could it ease some of the central bank demand for gold that's been partly driven by geopolitical risks? We've seen gold prices recently break above the 4,000 US dollar mark, and foreign central banks now hold more gold than US treasuries for the first time since 1996.
Okay, well, Samuel, you touch on the issue of Russia. And
Yeah.
so, if we look at the president in Russia, Vladimir Putin, he hasn't been that excited to get to the negotiation table in terms of brokering a peace deal with Ukraine. And I think that's because Putin wants one last crack at that line of defense. And I think when it becomes quite apparent that Russia's not going to be able to annex more land in Ukraine, that's when the situation starts to look like they may not win more of the war. I think that's going to push them towards the negotiation table. And then we can see some sort of peace agreement being put into place. I think that economic pressures are starting to pick up quite considerably for Russia. We've already seen quite a steep drop in their revenues from fossil fuel sales. Now, we know that they found alternative markets outside of Europe. They send a lot of their stuff to emerging markets, including India. But of course, that has come with a price drop. So the overall revenue in rubles has actually come down. And so there is a lot more economic and fiscal pressure for Russia, meaning that they do need to get to that negotiation table at some point. If we think about the peace deal that's been brokered in Gaza, I do believe that's going to reduce that immediate geopolitical risk. But if you want to have a longer peace process in place, it means that all the action items on that peace deal need to be adhered to. There can't be any ifs and buts coming through from Hamas or any other parties that are conditional to this agreement actually fulfilling a peace agreement in the region. And so while I think for now we could get a bit of a lull in geopolitical activity, this has always been a hotbed for geopolitical risk, the Middle East in general, because of these long-standing ideological issues. And I think this could potentially come up again in future, especially if this plan is not adhered to very strictly. Now you ask about, the demand for gold, and I do believe there's a structural underpin for central bank demand for gold. We've seen quite a sharp pickup in the gold price, which means that we maybe see a tactical pullback, but I think there is a structural force underpinning demand there coming from central banks because they are largely price insensitive at these levels. They want to buy gold because of geopolitical risk, and emerging markets still have quite a long way to go before they get to those average world levels of FX reserves.
So continued support for gold is not completely off the cards. I think maybe turning to Asia, China has been grappling with deflationary pressures. How is the government there responding to this? And more broadly, what can we expect in terms of global inflation and the direction of interest rates?
Well, China has a couple of things in their toolbox to make the economy pump again. The one is on fiscal stimulus, and they have been issuing a number of special infrastructure bonds. So that pushes up your fixed investment angle, and that contributes to economic activity. And then on the monetary policy front, they still have a bit of room to actually cut lending rates to spur borrowing for consumers and for businesses. Now, in China, we've seen over the last 2.5 years or so that pipeline pressures on inflation have actually been in negative territory. So we have deflation from a pipeline measure perspective in China. And as a result, we've seen that China has exported this deflation to the rest of the world. So while they aren't actually exporting as much to the US, they have found other markets like Africa. And this has caused quite a big divergence in inflation outcomes in the world. So the rest of the world experiencing tariffs like a demand shock. So that's been disinflationary, positive inflation, but falling inflation. And for the US economy, it's actually been a supply shock because that's the economy that's actually imposing the tariff on other countries around the world. And so that's actually been pushing up price pressures in the US market. Now, even though the US is likely to see inflation picking up over the next couple of months or so, the market still believes that interest rate cuts are forthcoming in the US. So if I look at Fed futures, they are pricing in up to 4 interest rate cuts by the end of 2026. But with that inflation divergence in the world, that has now led to a monetary policy divergence in the world. So while the US is expected to cut by 4 times, the ECB is probably going to stay on put levels until we get to the end of next year. If we look at the Bank of England, they are still contending with high levels of inflation, particularly on the wage front. And so even if we do get interest rate cuts there, it's probably going to be a second half of 2026 story.
Okay, so turning to South Africa and picking up on that interest rate theme, the South African Reserve Bank recently announced that its preferred inflation level is now 3%, down from 4.5% previously. Markets have viewed this favorably, and once formally announced by the finance minister, it will yield some benefits such as lowering borrowing costs for government, businesses, and consumers, while also supporting purchasing power. What are the risks for the inflation and interest rate path?
So even though all the stars have aligned for inflation in South Africa, I still think there are some key upside threats. The one is coming from the electricity tariff. We know that the energy regulator, NERSA, made a small little error of 54 billion rand on Eskom's revenue calculation. And so that means that consumers are probably going to face an increase in their electricity tariff of between 8 and 9%, not only for next year, but the year after that as well. And so that's quite a long way off from where they want to target inflation in SA. And on top of that, medical aid inflation, which is your second biggest component of services inflation, the first being rental inflation. Here, looking at the medical aids out there, I mean, including some of our competitors from a health business perspective, it looks as though those tariffs are going to come somewhere between 7.5% and 9.5%.
Quite high.
So it's quite high and quite a bit above, the rate of inflation that they want to target. And so we see those as key upside threats. Now, fortunately for us, the Rand, despite all the geopolitical turmoil and the local political upheaval, has actually been quite contained. And so we've seen quite a well-behaved currency domestically, partly because of a weaker dollar since the start of the year, partly because of this risk-on sentiment in global markets, but also because of a positive terms of trade. So in other words, the stuff that we export to the world, such as gold and platinum, have gone up in price by 55% for gold, almost 80% for platinum, whereas the stuff that we import, like oil, has come down. So the price of oil since the start of the year down 15%. And so that has contributed to a favorable terms of trade and favorable Rand outcomes for South Africa. And we have also seen that inflation expectations have been trending lower. So analysts believe when the Reserve Bank says that they are going to target 3%, and those expectations have now adjusted lower. So for us to eventually get to that 3% target and make it easier for the finance minister to make that decision, I do think we need to be able to see fiscal prudence in order for it to be successful and for inflation expectations to head lower. I think if all those stars align, then we could potentially get more cuts in interest rate policy, potentially one in 2026 of 25 basis points and another in 2027.
That would be good for the consumer. So earlier on, we spoke about how other countries are trying to shield themselves from trade tariffs and these shifting power dynamics. With the African Growth and Opportunity Acts, popularly known as AGOA, having expired on the 30th of September this year, there is uncertainty over its renewal, and this has heightened concerns about South Africa's trade relations with the United States. How are trade talks with the United States evolving now?
Well, we started off on a bit of a rocky front, but it looks as though the framework deal is developing as South Africa has made some concessions and tried to meet the US on middle ground with things like importing poultry and blueberries and liquefied natural gas and committing for South African firms to invest more in the US. But outside of the trade issues, I think for us to truly repair relations with the US, we also need to address a number of policy issues. And there are 3 that come to mind. So the first is around including null compensation as a line item in the expropriation bill. The second is we need to become really push having an ambassador to the US. And I don't think we've made enough strides in that regard. And we need to have this being someone that the US can take quite seriously in trade and investment relations with South Africa. Thirdly, I think, South Africa has been blamed for taxing capital on arrival. And this has been through the BEE policies and regulations that has been quite a dampener for foreign capital. Now, outside of the US, because they account for less than 8% of our exports, South Africa has been trying to deepen trade ties with other Asian markets, Middle Eastern partners, even other African nations. But I think a lot more needs to be done for South Africa to increase its exports to the rest of the world. So as an example, we need to make sure that we have enough foreign trade representation across the world to showcase South Africa. We need to have more trade fairs to show where South Africa can be competitive in this export landscape. And lastly, we need to align with global standards. Other countries are embarking on processes of digitizing customs and having tracing requirements. And so if we go that route, it will make it much easier for South Africa to get our products into other countries.
Talks of trade diversification are encouraging, especially given our weak economic growth. SA's economic growth did surprise on the upside in the second quarter of 2025, but both consumer and business sentiment weakened in the third quarter. The Government of National Unity has provided a degree of stability, but optimism has faded, and we have the next round of local government elections coming up between November 2026 and January 2027. The elections are a while away, but we are already starting to see some political activity pick up. How might sentiment on the ground shape the election outcomes, especially given the rise in service delivery protests and growing concerns around the security cluster being unpacked in the Madlanga Commission?
Well, a lot of what you mentioned here really impacts the consumer negatively in terms of sentiment. And if we talk about service delivery protests, these are actually monitored by Municipal IQ, and we've got data for the first half of the year. But if we had to say that the same number occurs in the second half, this year could be the highest on record in terms of the number of service delivery protests, and that really talks to ANC failures in a number of metros. Now, if we think back to the 2021 local government elections, the ANC might actually struggle to retain support in some of the key metros. Their margin of victory in Tshwane, City of Johannesburg, Ekurhuleni was extremely thin back then, and so you only need a little bit of a shift in order for the ANC to lose that power base. And I think what adds to the complexity of the local politics in South Africa here is the fact that Democratic Alliance Helen Zille is now going to be running for the mayoral position in Johannesburg, and that could alter the dynamics for Gauteng as a province. And that, of course, can then lead to a lot of complexity come time of the 2029 national elections, where the balance of power can be significantly altered, and we could potentially see coalitions in quite a different shape or form.
So let's turn to the network system. Kusile Unit 6 came online, and Kusile is now fully operational after 17 years since the investment decision, and at a final cost of roughly 161 billion. This is almost double the original estimate. Nevertheless, Kusile and Medupi power stations combined now deliver up to 9,600 megawatts when they are fully operational. Furthermore, the number of unplanned shutdowns has also come down, and this signals tangible progress on the ground. Beyond that, we've seen steady progress on momentum, particularly across the three sectors that make up 80% of our infrastructure, and that is energy, logistics, and water. And I think this continues to anchor our positive outlook for economic growth in the medium to long term. Can you give us a sense of what's been achieved on the reform front, especially relating to these three sectors over the past quarter?
Well, maybe let's start with energy. We know that there has been a lot of interest in renewable energy from the private sector, to the extent that we actually ran out of transmission grid in 5 of our provinces. And so now government is making additional steps to ensure that we have enough transmission network, and we will be soon entering phase 1, where the actual investment will start hitting the ground. And that also involves a lot of foreign interest in terms of the funding for that. If we look at the water space, in August, a number of legislative pieces went into Parliament to try and split the water service providers out of the water service authorities. And what that does is that it then enables the private sector to begin to play in that space to become providers of water. And we can actually increase security of water supply and sanitation services there. We've also seen a ring fencing of revenues at certain municipalities on the local government side. So that means that the water and electricity revenue that they receive then gets reticulated into infrastructure for water and for electricity, so that we don't have the situation in Joburg where more than 45% of the water is lost through leakages. And then finally, in the logistics sector, we've seen that 11 private freight operators have now been granted conditional access to more than 40 of the railway corridors in South Africa. So that would include sugar lines, manganese, ferrochrome, coal, etc. And ultimately, what that does is create a far more competitive landscape in logistics, which can help to lower prices in future.
It's indeed positive that South Africa's reform momentum is moving in the right direction, even if slow at times. Of course, the path ahead won't be without challenges, from subdued growth and political uncertainty locally to global headwinds like trade tensions and policy shifts in major economies. It is a complex environment, but one that still offers opportunities for resilience and renewal if momentum is maintained. Thank you.
Thank you, Sanisha and Siamo, for unpacking the geopolitical environment and turning the uncertainty into strategic opportunities. In a changing world, the bold adapt their growth plans to move forward while others fall behind. Next is Flobella Yates and Gregoire Sharma, who will have a discussion about equilibrium without borders, how we continue to add value in our global portfolios.
Thank you for being here today, Gregoire. I wanted to start off by asking you what you believe are the biggest advantages of having a truly global team.
Thanks for the warm greetings, Fluff. It's lovely to be here and always a pleasure to see you too. One of the greatest advantages of being part of a truly global team is, one, the depth and diversity of perspectives we bring to the investment process. We have colleagues based across geographies in South Africa and the UK, spanning a wide range of specializations from macroeconomics, strategy, portfolio management, as well as asset class expertise. And we're really able to approach investment decisions from multiple complementary angles. We also benefit not just from formal discussions, for example, our quarterly asset allocation meetings, which combine colleagues from South Africa and the UK, and be it in person or via regular online meetings, but also ongoing informal knowledge sharing across the team, which often adds real value, I find, in refining our views. A good example is having our senior economist, Sanisha, join our London meetings remotely from South Africa, to provide real-time insight into global and local macro dynamics, or even reading through the thoughtful work produced by the head of research, Herman. And all of this really helps sharpen our thinking. I also think as important really is our regional presence, which enables us to maintain close relationships with fund managers as well as counterparties around the world. And it really ensures we're always plugged into relevant on-the-ground developments. We're also able to help each other facilitate meetings with those fund managers. So in short, the structure of our team really allows us to combine global insight with local access.
Yeah, I agree with you. And it's actually, I had a prime example when Gary was out in South Africa joining us for our manager research meetings. And he asked after 2 or 3 meetings why all the South African managers had the same offshore arbitrary mid-cap stocks in the portfolio. And I didn't know the answer. So my initial thinking is, I said to him, well, I suspect that they use the same research. Anyway, we phoned the 3 managers back, and that's exactly what they were doing. Same buy-side research, buy-side research, and so they were using the same stocks. So, I guess, can you give us some practical examples of how having members of both teams in these sorts of meetings has helped you be a better investment professional?
Sure. Well, I always like having several members of our team join our fund manager meetings. I find having colleagues from both the South Africa and UK teams in those meetings has always been incredibly valuable. The variety of questions, angles of analysis, the perspectives brought by team members with different backgrounds and areas of expertise always elevates the quality of the discussion. Often surfacing risks or opportunities I might not have considered on my own. When we meet with fund managers, we all come in with our own agendas and biases. Some of us might want to dive into the strategy's performance. Others are curious about the investment process or updates on the team. And some just want to get insights on specific holdings. And so that's why having colleagues with different backgrounds, different perspectives is so valuable. It really helps make those conversations much richer and more balanced. And in fact, for example, when you, Fluff, came to London with Kamini recently, we had a series of meetings lined up with different managers. One of those that stood out was our meeting with Jennison at the PGIM office, because we were able to build on each other's questions and insights. I really, personally got a lot out of that discussion compared to whether I'd gone there on my own. And it's really a great reminder, in my opinion, of how collaborative work truly elevates the experience. Similarly, members of the investment team based in the UK are often made aware of offshore managers active in the South Africa market by our colleagues in South Africa. And again, you yourself, Fluff, helped organize meetings with such managers. The meeting with Omba springs to mind. And that helps greatly when doing a full due diligence. So to your question, how has it helped me become a better investment professional? Well, hearing how others frame their views or challenge fund managers helps me improve the way I assess strategies, as well as ask questions and in general, think more critically. I'll have been here almost 3 years as of next week. And I've definitely noted how this collaborative dynamic has broadened my perspective, deepened my understanding across asset classes, and also encouraged a more global, nuanced approach to manager evaluation and portfolio construction.
I think that's all very relevant, and we learn as much from you. And also, it's amazing how easy it is to get meetings with offshore managers when you're based in South Africa, just because we have that global presence, and that collaboration works so well for us. So really I agree with you on all those points. In the offshore market, the investment options are so much wider than those in South Africa. And one of the asset classes that is really interesting is the alternative space. And your market allows us to invest in various strategies that we wouldn't get access to locally. Can you please talk through some of these and why you feel that they are natural diversifiers in a portfolio?
Sure, absolutely. As you mentioned, one of the big advantages of accessing offshore markets is the chance to tap into a much wider range of interesting investment opportunities, especially alternatives that just aren't really available in the local South African retail market. I'm talking about private asset strategies like infrastructure, property, private equity, but also some really niche areas like aircraft leasing or even music royalties. Those types of investments offer unique sources of return and tend to behave quite differently from traditional stocks and bonds. Those assets are great diversifiers for several reasons. First, they usually have low correlation with listed markets, which helps reduce overall portfolio volatility. Secondly, they often generate steady income through contractual cash flows, so they provide a more reliable return stream, if you will, that complements the ups and downs of equities. Third, many of these real assets act as an inflation hedge, which is important for preserving purchasing power over time. And then finally, they allow us to invest in long-term structural trends like the global shift to renewable energy, or the growth of digital infrastructure, or even rising demand for life sciences and research space. Now, in South African retail funds, generally, we can't access these private markets directly. So instead, we get exposure through offshore closed-ended vehicles such as investment trusts. And those are listed companies that manage diversified portfolios of illiquid assets, but with a fixed pool of capital. And that's really key because it allows managers to take a long-term view without worrying about investors putting money out. And since they're listed, we can buy and sell shares as needed while still capturing the unique return and income profiles of private market assets. That structure gives us access to a broad range of opportunities, from data centers, mobile towers, subsea cables, to wind farms and battery storage within the renewable space, as well as residential, commercial real estate. So we also gain that exposure to top tier private equity managers like Partners Group or Molten Ventures, but also world-class hedge funds like Brevan Howard Macro Fund. So on the specialist finance side, we invest in some interesting strategies like that generate income from aircraft leasing and music royalties, and these are assets that really don't move in sync with traditional public markets. And in fact, we launched a fund of investment trusts in April of last year called the Real Assets Growth and Income Fund, or RAGI for short. And that's a daily traded UCITS fund that's performed really well since inception. It's outperformed its peers with lower volatility, so we're really happy with that. And it currently yields around 5 to 6%. It targets total returns of 7 to 8% annually, and as a result, it's quickly become a core diversifier in our offshore portfolios. So here in South Africa, we think it's a great opportunity for portfolios, and it's currently going through regulatory approval right now. I'd like to touch on one interesting point, though, about this investment trust market in the UK, because that's an important factor. It's currently trading at historically wide discounts to net asset value, and that's largely due to the sharp rise in UK interest rates last year. And what that's done is created an interesting entry point for long-term investors. And we're already seeing those discounts starting to narrow thanks to share buybacks from the investment trusts, but also a wave of mergers and acquisitions, thanks to pension funds and private equity firms that are seeing the big opportunity there, and they're looking to pick up these undervalued assets. RAGI itself has benefited directly from this trend. We've already had five of its holdings having already received bids over the past year, and that significantly boosted performance. And we expect that trend to continue, which should add even more value and upside to what's already a highly differentiated income generating portfolio. Another example, if I may, is the Curate Sustainable Equities Fund, which is managed by Robeco. It's a systematic, data-driven strategy that's also low cost, and it really leans into Robeco's deep research capabilities. The fund invests across a broad range of developed market equities. It focuses on the most sustainable companies out there. And it's designed to deliver strong long-term growth and outperform the index, which it's managed to do very well. What I really like is that it offers global market exposure and fits really nicely as part of a diversified portfolio. It's a multi-factor strategy. It blends quality, value, and momentum factors, but with a strong ESG overlay. The portfolio itself typically has 20 to 30% lower environmental footprint than its benchmark. And on top of that, it's aligned with the UN Sustainable Development Goals, excluding companies that have a negative impact on any of the 17 UN Sustainable Development Goals, which adds the impact investing dimension that many clients are looking for. Sorry, long-winded answer, but I hope that answers it.
No, that does answer the question. And maybe just for our advisors that are watching the recording today, I hope you get from this that the team is constantly looking for ways to diversify portfolios and for opportunities outside of the traditional asset classes that we get in our own local economy. And you mentioned two funds, the Curate Global Sustainable Fund, which is a fund that we already use. We used it a lot earlier in our offshore portfolios where we don't have to invest by our feeder fund. But we have also started adding it to local portfolios. And then the other fund you mentioned, the Raggy Fund, is a fund we've been watching since before you launched. We were looking at the strategies. In fact, we spent quite a lot of time as a global team when we were in the UK with your team looking at it. So for investors, watch the space. We do, as Gregoire mentioned, have to wait for regulatory approval, and these things take a little bit more time. But hopefully it'll be a strategy that we can invest in down the line. So thank you, Gregoire, for sharing your insights. It's lovely to have you personally in the studio in South Africa and coming to see some clients with us. So thank you, and I hope you'll be back often.
I look forward to it, yeah.
And thank you to all of you for attending today. As you know, we try every quarter to have different thought leadership pieces and different of our portfolio managers. So I hope that it gives you insight into what a broad team we have, but also the depth of expertise and the advantage of having skill sets not only based in our own economy, but around the world. Thank you, Gregoire.
Thank you.
Thank you to all of you.
Thank you, Fluff and Gregoire. Next up, Equilibrium Portfolio Manager Tami Koza will talk about accountability in focus from commissions to capital markets. Over to you, Tami.
Thank you, Robin, and a very good day to our valued clients, our colleagues, and partners. Thank you for joining us today as we explore a topic of growing importance: accountability in focus, from commissions to capital markets. In South Africa, the launch of the Madlanga Commission, set to investigate political interference, corruption, and the health of our institutions, marks a moment of reckoning. When institutions are called to account, practices are scrutinized, policies are reset, and the ripple effects can reach into the economy and the markets. At the same time, across the world, we see uncertainty emerging from multiple sources, that is, governance challenges in the US, geopolitical friction in the Middle East, supply chain vulnerabilities, and inflation persisting longer than expected. In this environment, accountability is no longer just a virtue. It's a strategic asset. Investors are paying sharper attention to how companies are governed, how institutions respond to oversight, and how markets adjust to shifts in responsibility and transparency. That's where your role as advisors and our role as dedicated investment partner becomes especially meaningful. We believe that in these times, you deserve a partner who can help you navigate complexity, decode the signals, and leave you free to focus on what matters the most: serving your clients, building relationships, shaping strategies, and growing your practice. This is not about unnecessary complexity or chasing every headline. It's about staying grounded in strategy, responding when it matters, and keeping you aligned with client objectives. In a world where accountability is increasingly baked into both policy and markets, the value of partnership rises. Let's now transition from the broader macroeconomic landscape to how this has translated across markets. We'll take a closer look at how asset classes performed over Q3 of 2025. Local cash, represented by the STEFI Composite Index, was the clear underperformer among local asset classes this quarter. With the SARB continuing its rate cutting cycle, returns moderated to 1.8% for the quarter and 7.8% over the past year, although still comfortably ahead of inflation. South African nominal bonds extended their rally, supported by the SARB's confirmation that the 3% lower end of the inflation target is now the preferred anchor. Strong foreign inflows added further momentum, driving the ALBI up 6.9% for the quarter and 14.5% year-on-year. In listed property, falling bond yields and improved earnings guidance lifted sentiment. The FTSE All Property Index advanced 5.5% for the quarter and 11.4% over the past year. Local equities and the elephant in the room continued their strong run, with the CAP SWIX surging 12.8% during the quarter to close the year up 28.1%. Casting our eyes onto global asset classes, bond markets remained volatile amid heightened fiscal and political uncertainty. The FTSE WIG-B managed a modest 0.6% gain in US dollar terms and a negative 2.8% in rands. This was largely due to strength in US treasuries. European and UK bonds ended slightly lower. Global listed property added another solid quarter, rising 4.2% in US dollar terms and 1.2% in rand terms. In equities, developed markets ended the quarter up 7.3% in USDs and 4.1% in rands, as a stronger rand tempered offshore returns. Meanwhile, emerging markets outperformed in a broadly risk-on environment, with the MSCI Emerging Markets Index gaining 10.6% in US dollars and 7.4% in rand terms, bringing the 12-month rand returns to 17.5% and broadly in line with developed markets. The strength in EMs was driven primarily by China, Taiwan, and Korea, due to progress in US-China trade discussions and renewed optimism around AI-related growth sectors. From a currency perspective, the rand strengthened by 2.1% over the quarter and weakened marginally over the past year. Taking a closer look at the performance of the underlying JSE sectors over the past quarter and year, it's clear that returns were overwhelmingly driven by the resources sector. This was supported by gains in both gold and platinum prices. Resources surged by 46.8% in the third quarter alone and have nearly doubled over the last 12 months, up 86.5%. On an individual stock level, Anglo Gold Ashanti and Goldfields rallied 47 and 72% respectively during the quarter, while platinum counters such as Valterra Platinum and Implats gained 59 and 38% respectively. By contrast, performance from industrials and financials was far more subdued, up 3.7 and 1% respectively for the quarter. While industrials delivered a 19.8% return over the past year, it pales in comparison to the outsized gains that we've seen in resources. Financials, as part of the SA Inc. group of shares, remain under pressure, returning 6.3% over the year. It's worth remembering that much like the US S&P 500, the local market rally is being driven by a narrow group of shares, raising the risk of concentration within portfolios. To put these dynamics into perspective, it's helpful to recall how quickly leadership can shift. At the end of last year, following the local elections, financials and industrials led the charge, rising 20.1% and 18.7% respectively, while resources lagged with a 6% decline. As shown in the next chart, the rise in the gold price has been nothing short of remarkable. At the start of the year, gold was just breaking above the $3,000 per ounce mark, and it has since climbed beyond $4,000, reflecting one of the strongest rallies in decades. If we zoom out and look at the long-term picture over the last 50 years, we can see that this isn't the first time that gold has experienced sharp surges. Similar spikes occurred in the early 1980s during periods of high inflation and geopolitical tension, and again around 2010 in the aftermath of the global financial crisis. This is a reminder of how history often rhymes. Gold's renewed strength is a reflection of sentiment, as investors once again seek safety amid global uncertainty. Over the past few quarters, the sharp rise in valuations and heightened concentration within the market have pushed gold miners to make up nearly 15% of the Caps Fix Index, our benchmark, of course, for local equity performance. This is a dramatic increase from around 4% prior to the COVID pandemic. This represents a near fourfold rise in the weighting. In fact, when combining gold and platinum counters, they now account for 26% of the index, compared to just 8% for the broader resources sector a year ago. Much like the Magnificent Seven phenomenon in US equities, the growing concentration has led to meaningful short-term deviations from benchmark performance for our active equity managers, many of whom have been underweight in these areas. It's important, however, to remember that risk management is as critical as return generation in portfolio construction. Managing exposure responsibly can result in short-term differences versus the benchmark, but it ensures that portfolios remain balanced and resilient over the long term. Many equity managers remain cautious on gold companies, given the valuation challenges and inherent volatility of the sector, and as a result, may intentionally hold them below benchmark weights, even in the face of strong near-term returns. While gold stocks have dominated recent headlines, it's equally important to zoom out and consider how the broader South African equity market is currently valued. As the recovery in South African equities continues to gather pace, it's worth noting that the market still appears attractively valued relative to its long-term price-earnings average. This is a compelling setup for investors with a value-oriented lens. Encouragingly, South African corporates maintain limited direct revenue exposure to the US, meaning they are less vulnerable to the recently announced 30% tariff increase on select imports. This differentiates South Africa from other major emerging markets such as Taiwan and South Korea, which have far greater trade linkages with the US. Moreover, the South African equity market remains under-owned within global emerging market portfolios, with South Africa ranking among the stronger performing markets in 2025, we could see renewed foreign investor interest, potentially driving fresh inflows and supporting a re-rating of local valuations in the months ahead. On the fixed income front, South African government bonds continue to stand out, offering some of the most attractive real yields globally, second only to Brazil within the emerging market universe. Looking ahead, the forward-looking real yield remains above 5%, which is roughly 0.7 standard deviations above its long-term average since the introduction of inflation targeting. What this means is that with the SARB maintaining its downward interest rate trajectory, the environment remains broadly supportive for local bonds. This backdrop reinforces our conviction in local assets over global alternatives, underpinned by compelling valuations and improving fundamentals. Let's now shift from the broader market context to how these dynamics have translated into the performance of our portfolios. Quite pleasingly, all portfolios delivered solid returns over their respective time horizons, with the income, conservative, stable, moderate, and balanced portfolios outperforming their respective benchmarks. The more aggressive strategies, namely the growth and unconstrained portfolios, faced headwinds and underperformed relative to their respective benchmarks. It's important to note that the degree of underperformance has reduced significantly, closing the quarter at only 0.4 and 0.1% respectively. Also, quite encouragingly, performance relative to peers was strong across the board. All portfolios outperformed their respective peer groups over their time horizons, with the exception of the income portfolio, which only lagged by 0.2%. Having reviewed overall portfolio performance, let's now unpack the key drivers behind these results through our performance attribution analysis. Over the one-year period ended 30 September 2025, both strategic and tactical asset allocation added meaningful value to performance. Over the one-year period ended 30 September 2025, both strategic and tactical asset allocation added meaningful value to portfolio performance, reflecting sound positioning across asset classes and responsive shifts amid evolving market conditions. However, manager selection detracted over the same period, highlighting areas where underlying manager performance lagged expectations despite a supportive asset allocation backdrop. From a tactical asset allocation perspective, the two most significant contributors to performance over the period were an underweight position in local cash and an overweight allocation to local equity. This positioning reflected a conscious tilt away from lower yielding defensive asset classes towards more growth-oriented exposure in the local equity market, where strong returns were captured across multiple portfolios. These outcomes underscore the benefits of tactical asset allocation, navigating market conditions and balancing prudence with conviction in asset class tilts. The aim, of course, is to capture opportunities in a dynamic environment. From a manager selection perspective, performance over the period was mixed. The most notable contributors came from our global equity managers, who navigated volatile markets quite effectively. They captured upside from both developed and emerging market opportunities. Momentum Enhanced Yield, one of our local cash managers, also added value, supported by their positioning through the interest rate transition and efficient yield management. On the other hand, local equity managers were among the detractors over the period. This was largely due to their underexposure to the concentrated group of outperforming resource stocks, particularly within gold and platinum counters. Meanwhile, local bond managers featured on both sides of the spectrum, with Momentum SA Flex adding value through duration and yield curve positioning, while Visio Unconstrained detracted as the SA bond rally moved against them. Overall, this highlights how divergent market conditions tested manager styles and positioning, underscoring the importance of manager diversification and active oversight within our portfolios. Let's migrate to our tactical asset allocation views for the next quarter. We continue to favor local assets over global exposures. This is supported by both stronger fundamentals and more attractive valuations. On the global front, the softer US dollar, rising tariff tensions, and ongoing geopolitical uncertainty have collectively weighed on the outlook for global assets. That said, targeted fiscal and monetary stimulus, particularly in developed markets, may continue to provide some pockets of support for global equities in the near term. Reflecting these dynamics, we are underweight local cash as well as global bonds, where yields have compressed and prospective returns are less compelling, respectively. Conversely, we are overweight in local equities and global emerging markets, both of which continue to offer superior value and long-term growth potential. We remain neutral across the remaining asset classes, balancing opportunity with prudent risk management in what remains a fluid and fast-changing market environment. This quarter, we are implementing two key portfolio changes following a review of our building block allocations and manager lineup. Starting with local equity, we are introducing truffle equity and momentum trending to our blend. The objective of this change is to ensure an optimal balance across our three style factors: quality, value, and momentum. Our analysis indicated that this will strengthen diversification and improve the consistency of returns across different market environments. Turning to global emerging markets, we are introducing the Curate Global Emerging Markets Fund, a systematic manager that brings a quantitative, data-driven approach to stock selection. The fund's value proposition lies in its broad market exposure, predictable risk profile, and cost-effective implementation relative to traditional active peers. It also integrates sustainability considerations and ESG principles more deeply. This aligns with our forward-looking approach to responsible investing. Together, these enhancements aim to refine portfolio efficiency, broaden our source of alpha, and enhance long-term consistency for our clients. As we bring today's session to a close, we'd like to extend our heartfelt thanks for joining us. In a time when accountability across institutions, markets, and governance structures are being tested and redefined, your continued trust and partnership mean more now than ever. To our valued clients, thank you for the confidence you place in us to navigate uncertainty with both prudence and purpose. To our colleagues and investment partners, thank you for your collaboration and for upholding the standards that keep our industry transparent and resilient. And to our stakeholders and broader investment community, thank you for walking alongside us as we align our actions, not only with performance, but with principle. As we continue from commissions to capital markets, may we all remain guided by integrity, clarity, and accountability, as these are the foundations of lasting value. Until next time, take care and keep well.
Thank you, Tommy. With accountability in focus, we're bridging the gap from commissions to capital markets through transparency and trust. Lastly, but certainly not least, we move to our colleague in London. Please welcome Richard Stutley, a senior portfolio manager from our London Ingram office, who will tell us about what the implications are for global portfolios during the Trump versus the Fed. Welcome, Richard.
Thanks very much, Robin. Okay, I wanted to start with just a brief reminder about the team on this slide. In terms of the portfolio management team in London, you'll be familiar with myself and Jade there at the top. Jade comes back from maternity leave very soon. You may be less familiar with some of the other key individuals, however. So there at the bottom, Gregoire, Lorenzo, and Alex, who in fact heads that portfolio management team in London. And I make the point just because you should expect to see and hear more from these other guys in the coming quarters. Okay, on to market. Here we go, this first slide. We remain in what I like to call an everything rally, all the lines rising to top right, which is what we want. You've got gold at the top there on this fantastic run. At the time that I now come to when I'm recording, gold's pulled back a little bit, but it's still had a fantastic year. So gold at the top. Next, emerging market equities. They've had a long period when they've not done as well as developed markets. They're doing well this year. Next, you've got developed market equities, and finally at the bottom there, you've got global government bonds. Nowhere near as much as those other asset classes, but still not bad. So it's been a good time to be invested. In terms of the picture, of course, we can see there, and you'll remember in April, tariff fears led to that sell-off. But then we had a really strong rebound in the latter part of Q2, and that continued, thankfully, in Q3. And that's because those tariff fears started to abate. The US very swiftly concluded deals with the likes of Japan, the EU, and entered into negotiations with China, which are still ongoing. Here then, what's been going on within specifically the equity markets? Well, in the first part of the year, up until April, it was equities outside of the US doing really well. Post-April, post so-called Liberation Day, it's then been the US, which has rebounded the strongest. It's been things like the Magnificent Seven. And on this next chart here, we just dig into a bit more detail. You see it's really been those AI-linked big companies like your Nvidias, but also your Apples and your Alphabets that have been doing really well. And interesting to note, this is not just in the US. You've got the big Chinese tech leaders also doing well, as you can see there, Alibaba, Tencent. So that's been the area of markets that have really driven returns post-April. In terms of bond markets then, here focusing on government bonds, you'll have heard a lot about bond volatility, and there's great excitement whenever yields move up 5 basis points and then come down 5 basis points. The reality is, if you look at this chart going back over the last 18 months or so, yields have been pretty range bound. And this picture is absolutely fine. Why do I say that? I say that because at the top there, you've got your 10-year Treasury still paying you of the order of 4% today. That's a decent yield that you're collecting. And alongside that, there's plenty of room for yields to go lower, the capital values, therefore, to go up. And what would do that? What would do that, of course, would be a negative economic outcome. So bonds are doing what you want. They've given you that income, and they're there if you need a little bit of protection. That was government bonds. In terms of credit, here we're looking at credit spreads, and they've also been pretty well behaved. This is a long-term chart. What we're looking for here is any signs that credit spreads have started to go up. They did around April time. They subsequently came back. The fact that they've been pretty well behaved means, of course, that you've outperformed by holding credit over government bonds. So again, no problems as yet within the credit space looking backwards. And then finally, the dollar is always very topical. Of course, we had that sell-off, but that was very much focused on Q1 this year. Thereafter, you can in fact see that versus some of these currencies here, the euro, the yen, sterling, in fact, since April, the dollar's very much been moving sideways. So a question I often get is, what would it take for us to see another sharp leg down in the dollar, reminiscent of Q1? And per the title of this quarter's presentation, I think the big one is this, and that is that is President Trump versus the Fed and everything that he has been saying and tweeting. The US is exceptional. The dollar is a stable and reliable currency, but those two things are only true as long as the US has exceptional institutions, and that includes a strong and independent central bank. And I say that because of this chart here. This is looking at long-term inflation, and it's the case that central bank independence has certainly coincided with, if not been the cause of this great period of stability we've had since the 1990s in terms of inflation. And yes, we've had a bad bout of inflation recently, but you can see in the context of what went before this period of central bank independence and inflation targeting, you can see that there was a lot more volatility historically. So central bank independence has worked, I would say. You lose that in America, and I think you're going to see more flows out of the dollar. How are economies doing? Yes, we're seeing a bit of a slowdown. That's not unexpected. That's the normal cyclical nature of economies. Here we're picking up that slowdown in the US housing market. Then on this slide here, the same picture in the labour market. It's a slow or a gradual slowdown. But of course, I'd say these two things are okay. They're okay on the basis that we've still got short-term interest rates above 4%. That means there's plenty of ammunition for central banks to come and assist the economy by reducing interest rates. But key to that, and hence the key question that remains, is still, as shown here on this slide, it's still inflation. And we're not out of the woods. We're not out of the woods because of tariffs, certainly. And there's been a bit more of a flare up in tariff-related chatter in recent weeks between the US and China, between the US and most recently Canada. So that's still the thing to watch. On this chart here, it's just pointing out that what's been really helping inflation, certainly headline inflation, is the decline in the oil price. So I'd say overall it's okay on the economic front, but let's not be complacent about inflation. How then are prices? Well, here, no real change in this picture. The US really stands out at the top there. Its equity market looks pretty expensive. Elsewhere, valuations are reasonable. How about bonds? Well, key to note that a lot is priced in terms of interest rate cuts. So yes, we may get some, but the bond market has already priced it in. You add those two things together and you've got big parts of markets in terms of US equities, in terms of US treasuries that aren't particularly cheap today. We've also had a great run. Add those things together, I think it's time to be a little bit cautious. And that's what we're doing in the portfolios. Not too cautious. I'm talking maybe an extra 5% cash. I'm not talking an extra 15% cash. And that's because outside of these kind of areas, we still find other investments that look pretty interesting to us. Okay, here then are the models. You're very familiar with this: cautious, managed, and growth. Next, here are long-term returns. In each instance, you want to compare the solid line against the dotted line of the same color. And thankfully, we're ahead in each of the profiles. Moving on then, here in the first column, if we start there are returns over the quarter. And I think the first takeaway, very obviously, another really big quarter. We shouldn't expect returns of this order of magnitude every quarter, but nice when it happens. So just starting at the top very quickly, Equilibrium Global Cautious doing 3.8% in Q3. That's versus Global Cash plus a margin of 2.5%. It did 0.7%. And of course, 4 times 7 is going to get you to around 2.5% for the year. The peer group median, where we outperformed that as well, that did 2.6%. Then down onto managed, it does the higher 4.6%. Global Cash plus a bigger margin of 4% does only 1.1%. So we outperformed. And indeed, we outperformed peers who returned 4.2% on average. And finally, at the bottom there, Equilibrium Global Growth, 5% ahead of its cash benchmark or target, and indeed ahead of the peer group median. So a pretty decent set of returns, both in terms of absolute return numbers, but also how do we compare against these reference rates. What drove that then? Here on this chart, if we start on the right-hand side, you'll see asset allocation. That was a smallish positive. We'll look in a moment at what drove that. Managed selection, a negative, however, and again, we'll look at that in a bit more detail in a moment. Net, what did it mean? Well, managed, which we're showcasing here, it's a very similar story with the other two portfolios, but we're just going to use managed as the example portfolio. It did, as I showed a moment ago, it did 4.6% in Q3. Decent return, certainly versus cash, certainly versus peers. But actually, another reference rate that I think is a fair one is a classic 60-40 portfolio. That's 60% equities, 40% bonds, and it actually would have done slightly more than 4.6%. So what we're showcasing here is that we left a little bit of money on the table. Where did that come from? As I say, asset allocation positive. We did the right things. Our managers didn't back that up on this occasion. Here we go then, asset allocation. Where did that predominantly come from? It came from our overweight to gold shares. That's 91. You can see on the rightmost column there, gold shares had this extraordinary quarter, up nearly 50%. Hence, that was a big contributor to asset allocation. We see gold as a core defensive asset in portfolios. It's done extremely well. It will have periods when it does not do particularly well, but it's there really to anchor the portfolio. So to us, it makes a lot of sense. Moving on then to managed selection, I said that was negative, and you can see an area where that came through here. One of our equity managers, this is Evenlode, who we hold within the Momentum Global Equity Fund. Remember that Momentum Global Equity Fund is just a wrapper. Underneath it are world-class boutiques like Evenlode. Evenlode, a weak quarter. They didn't ultimately have enough of the AI theme. That is similar with the majority of active managers that I look at. You had to have a huge amount in that particular area in order to outperform last quarter. Not a lot of managers did. So Evenlode, they have a weak quarter. Next quarter, who knows, it could well be a good one. Outcomes like this over the short term, like a quarter, are not particularly worrisome for us. And then finally, let's just go back to the numbers one more time. Here, what we've done is put a border around returns over the portfolio's minimum recommended holding periods. In the case of Global Cautious, 3 years, you've made 11.9% per annum, comfortably ahead of those two reference rates. Over 5 years in Global Managed, 6.7%, again outperforming its reference rates. And 7 years, ex equilibrium Global Growth, and you've made 7.4% per annum. So a really decent set of numbers. Thanks for listening, and we look forward as a team to updating you next quarter. Thank you.
Trump has certainly kept the markets on its toes, and thank you for providing insight into a client favorite topic, Richard. That wraps up our quarterly bulletin for the day. Thank you for taking the time to join us today and for your continued support. We hope the ideas and insights from this session add real value for you and your clients. If you have any questions or need help bringing our solutions into your advisory practice, we're here for you. Our investment specialists and portfolio managers are always ready to assist. Until next quarter in the new year, goodbye and take care.